Hello, this is the synopsis for Chapter 1 of Finance 310. I'm going to pull up the PowerPoints in a minute and share the screen with you and go over a brief synopsis. But before that, I wanted to just talk about the Internet Excel exercise at the end of the chapter. And so if you go to page 22 of the text, there's an internet problem that you're required to do, where you're going to go into Yahoo Finance, finance.yahoo.com, and you're going to search for IBM and just jot some things down about that company and analyze that company. And then for number 2, you're going to repeat the question, it's a repeat of problem 1, except you're using Children's Place. The ticker is PLCE. You're going to get the information for that company and then compare the two. All right, so I just wanted to give you a little bit of information on where to find the information in Yahoo. So when you click on IBM, it'll take you to the summary page. The main stock price that you see, that's the current price or the last trade. If the market's already closed, if it's after 3 o'clock when you do this assignment, you're going to see the closing price as the last trade. So that's what you would put as the last trade. Then if you go down, there's 2 columns there. And if you go down, I think it's in the second column, it will show you, it says range, day range. That's where you can find the high and the low for the day, because they're asking you what's the high and the low price. Also, they're going to want to know what's the total value of the company, total value of IBM stock, and that's the market cap. And so you'll see that there as well. Then they'll have 2 trading volumes. They'll have the daily trading volume and the average trading volume. And what they're asking for is the average trading volume. And then finally, you will click on the 5-year, or you might have to click on the chart first, and you click on 5-year, and it will show you the stock price for the last 5 years. So you can see the ups and downs of that. And then you'll see the same thing for Children's Place. Okay, so I'm going to share the screen now, and I'm going to pull up the PowerPoints. Just a second. Okay, sorry about the pause, but to be honest with you, I haven't made a video in a few years. And when I got back into YouTube, everything's changed in YouTube, the way you used to do it. It's definitely not as simple as it used to be. So the first one I did last night, it didn't share the screen. And anyway, hopefully this will work. Okay, so let's take a look at the slides here, and I'll try to be brief here. All right, so in this chapter, they're talking about financial markets and institutions and the role that financial markets play in allowing people, basically bringing together buyers and savers. All right, so when you think about the financial markets, you basically have 2 types of people. You have buyers, and you have savers, and you have borrowers. So in this book, they're talking about the savers as the surplus units and the borrowers as the deficit units. So the whole point of financial markets is to bring the surplus and the deficit units together, bring the buyers and the savers together, and facilitate transactions. Now, in the financial markets, you have primary markets and you have secondary markets. The primary market is when a stock is first issued. So if a company is going public for the first time and issuing stock, it'll go into the primary market. But as soon as that initial person who had access to the IPO, initial public offering, sells the stock, that's on the secondary market. So the vast majority of us, 99.9% of us, are buying and selling stocks on the secondary market, or buying on the secondary market. The primary market is just when stocks are initially issued. Now, money market securities are, we're going to also talk about money market, capital markets, and derivatives. Money market securities are similar to a savings account. If you want to make a little bit more money than you can make by putting your money in a savings account, you would put it into a money market account. Or if you had, an investment account and you want to just park your money someplace in cash, you would put it in a money market account. It's just they just buy short-term securities. They buy short-term bonds like government bonds and such that mature in 1 year or less. So you get a little bit more interest than you would with just a savings account or with a CD. And there's not much risk, of course, because we don't expect the government to default on these bonds. So that's what a money market account is. It's just a place to put your money short term if you want to, for low risk and a little bit of interest. Now, the capital markets are where you buy stocks and bonds. And so you'll see here we have bonds, which are long-term debt securities that are issued by the government and also by corporations. Then I'm going to come down here to stocks. Of course, you all know what stocks are. If you buy a stock, you're actually a part owner in the company. Whereas with a bond, if you buy a bond, you're a creditor. Then there's mortgages, mortgages for real estate. And then they have mortgage-backed securities. These would be bonds that are backed by mortgages as collateral, actual property as collateral. Okay, and derivatives are, if you don't want to buy a stock, I'm just going to talk about derivatives in relation to stocks. Derivatives are contracts that allow you to sell and buy stock at a certain price. And so people will use these derivatives if they don't have enough money or don't want to spend all the capital that would be required to buy the stock outright, they can buy an options contract, which gives them, where they pay a premium, they pay like $500 or $1,000, what have you, whatever it is, that gives them the right to buy 100 shares. Each contract is 100 shares, right? To buy 100 shares of the stock at a specific price or sell at a specific price. So just as an example, let's say you really thought a stock was going to go up, but you didn't have enough money to buy 100 shares of it. So you could pay $1,000 or what have you, and buy this derivatives contract. It would be a call option if you thought the price was going to go up. You could buy a call option contract on a stock. Let's say that a stock was at $100 and you bought an options contract, a call for $100. If the price then goes up to $110, you can exercise that contract and you would be able to, the contract allows you to buy the stock for $100 and then you turn around and sell it at the market price for $110. You make $10 a share times 100. And so just to repeat then, if you don't want to buy a stock outright, you can buy a contract that will give you the right to buy it at a certain price. So it's a way that investors can make a lot of money with just paying a little bit of money, because all you're out is the premium. But it's very risky because you're predicting the price to go up to a certain amount at a certain time, by a certain time. If you think stocks are going to go down, you can buy a put option. A put option gives you the right to sell. So if you thought a stock was going to go down, let's say it's $100, you think it's going to go down, let's say you bought a put option for $100. If the stock goes down to 90, you would buy the stock for 90 when you exercise the option, turn around and you could sell it for 100. So it's a way to make money buying put options if the stock, you think the stock is going to go down. Now, here they're talking about risk management. Companies will use derivatives to try to mitigate the risk. For example, you can buy options on the exchange rate if you're doing business overseas to give you a certain price on the exchange. You can buy options on oil, like gas. A lot of like, for example, airline companies will buy options contracts on the price of jet fuel so that they can mitigate the risk and have it just get it guaranteed at a certain price. But for individual investors, something called protective puts are what people will use to try to mitigate the risk. And that's when you buy a put option on a stock that you already own. So let's say you had shares of IBM is in your homework. So let's say you own 100 shares of IBM outright, and you think the price is going to go down, and you're worried, and you like to protect your profits. So you could buy a put option on IBM, and it would act as a hedge. So, for example, if IBM just continued to go up, then you just wouldn't exercise the put option. It just expires, and you're just out the premium that you paid. But if IBM starts to go down, what you're losing on the stock as it goes down, you're making on the put option. So you see, it's like a dollar for dollar situation. After the premium has been paid, you would actually not lose any money, because if the stock goes down, you lose money on the stock, but you make money on the put option. All right. We'll be in chapter 11. We'll be going over extensively how to value stocks. So I'm going to skip this for now. But basically, when you think about valuations, you look at one way is to look at the present value of the cash flows of the company to find out what the value of the stock should be. A valuation is the value of the company, which actually tells you what the value of the stock is. Then you can compare what you value the company at to what the stock is actually trading for to see if it's undervalued or overvalued. And there's several techniques that we use. The multiples model is one. Present value, finding the present value of the cash flows is another one. You can find the present value of the dividends, and so forth. So there's several ways. Now, when you read the section in the chapter on behavioral finance, that's at the beginning of the chapter. I think let me see, hang on a second. It's one. Sorry. 1-2D, and it's page 9 and 10. Make sure you read the section on behavioral finance, and they have a really good example talking about marijuana stocks and behavioral finance, and then the uncertainty with valuation, and there's a good example about Nike too. So make sure you read 1-2D very carefully, and then you can ask me in the next class if you have any questions. But what we're talking about with behavioral finance is that people don't behave rationally with their money. Lots of theories on behavioral finance and different terminology that they've coined. But in this chapter, what they're talking about in regard to behavioral finance is that some of these movements in price can be explained by behavioral finance. For example, if there's a lot of exuberance about a stock, then investors will buy that stock and run up the price beyond what its actual value is. Or if there's been really bad news about a stock, or if it's just out of favor, investors can sell it and run the price down below what it actually should be valued. And so that's where behavioral finance kind of comes into play, the emotion, if you will, of the markets. Because remember, the stock market is really just a market of buyers and sellers. If there's more buyers than sellers, then the market goes up, and if it's vice versa, it goes down. Okay, so this is just explaining how we use information to make investment decisions. In addition to looking at the value of the company and looking at the cash flows, we also look at the big picture. What's the economy looking like? What's the industry like? So we look at the economy overall, economic conditions, the industry, and then what's going on with the firm. Okay, this is just briefly, they talk about some of the securities regulations in the markets. As you all know, in 1929, the market crashed, and a lot of people lost a lot of money. It really affected it started the Great Depression. It really affected the economy. And so there was a lot of fraud that was going on in the 20s, a lot of speculation and fraud up to the crash. And so in order to prevent another crash, they came up with the Securities Act of 1933, which just prevents a lot of the fraudulent practices that were taking place in the market. That was for IPOs. In 1934, they expanded the Securities Act to include secondary market issues. And then the Sarbanes-Oxley Act was enacted as a result of a lot of the scandals that we had at the turn of the century rather. 2001, 2002, we had 2000, 2001, we had the Exxon scandal, we had the WorldCom scandal. And so this requires firms to provide more accurate information. And specifically, one of the tenets of the Sarbanes-Oxley Act is anybody at the business who has any input into the financial statements, whether it be somebody working on the line, someone in finance in a specific department, all the way up to the CFO, if they have any input into the financial statements or are responsible for anything that goes into those financial statements, they have to sign off on it, and they will be held accountable. Because what was happening with these, when we had these issues with WorldCom and with Enron going under, the CEOs were saying that they really didn't know what was going on. They weren't taking responsibility. So the Sarbanes-Oxley Act is to try to force these officials to take responsibility and to actually prosecute them if the financial statements are not accurate. And they want it to, the government wants these companies to be transparent, and these financial statements have to be accurate because investors depend on them. If investors didn't if investors didn't think the financial statements were accurate, then they would not invest in the market, and the market would not be around. The market would crash. All right. International markets are interesting. International markets have been out of favor for about the past decade. They haven't really made much money. The way to invest internationally typically is to buy exchange-traded funds or mutual funds in specific countries that invest in specific countries. So you can buy funds that invest in stocks in these specific countries, because it's difficult for us as U.S. investors. You can go to other markets, but it's very difficult. So the most common way is to invest in these funds. But you have to ask yourself, going forward, do you think the U.S. stock market is going to be a better place to invest than in other countries? And for the past 10 years, the answer has been yes. But eventually, these other markets will come around. A lot of times investors, financial analysts or financial planners will recommend somebody have between 5 and 20% in international investments, international funds. I haven't had any in a while, actually more than a decade. I used to have around 10%, but they haven't really been, they haven't looked very good. So I'm waiting for them to be a little bit more undervalued before buying an international ETF. But anyway, the easiest way to invest internationally is to buy international mutual funds or international ETFs. All right. Okay, what kinds of financial institutions do we have? Well, commercial banks are one. Y'all know what a commercial bank is. They take in deposits, loan out money. Savings institutions like savings and loans, they do the same thing. They act like banks, but they concentrate more on mortgages. And then you have credit unions that are nonprofit organizations. They basically act like a bank. And credit unions are a really good deal. I would recommend joining a credit union if you're able to belong to one. You have to be a member of some specific group, like having been in the military. You can join Navy Federal, or if you have relatives, parents, grandparents, or spouse in the military, or if you're, if you, it's usually people who work for government agencies that can join various credit unions, firemen, policemen. I think there's a credit union here at Nichols, actually, for Nichols employees, if you want to. But anyway, if you have the opportunity ever to join a credit union, I would recommend it because their fees are very low. Their interest rates tend to be lower, and they're just and they don't have the bureaucracy that you have with commercial banks. Okay, then we also have non-depository financial institutions. Those would be finance companies, mutual funds. Now, a mutual fund, if you don't know, that's for people who want to really diversify. In other words, if you don't feel like you have enough money to invest in individual stocks, or you don't want to, if you want to be more diversified, you can invest in a mutual fund. A mutual fund just pools people's money. There's all different kinds of mutual funds, but if I'm talking about just a stock mutual fund, a stock mutual fund would invest in, they pool people's money and they invest in a bunch of different stocks. So if you just put $1 into that mutual fund, you're already diversified. ETFs, they don't mention ETFs here. Exchange traded funds are another way to invest, but mutual funds are considered a non-depository institution. Also, securities brokers like Schwab, Fidelity, Robinhood now. Those are all considered non-depository institutions. And then you don't really think about insurance companies or pension funds as being financial institutions, but they are, because when you think about some of the largest institutions in this country, financial institutions are insurance companies and pension funds, because they have a lot of money. They have a lot of money to invest. Insurance companies, they get all these premium dollars, and some of it they'll have to pay out, but in the meantime, they have to invest it. And pension funds too have all this money that they're investing while people are working, and before they pay out the pensions. And I think that's about it. So financial institutions are very important, because they facilitate saving households. They enable them to save money, and then they give loans to households who are borrowers. And so it really helps the economy. As I was mentioning in class, it helped to create a middle class in this country, having a stable banking system and stable credit, and it does help society in general. Also, the banks, the savings and loans, and the credit unions are insured by the FDIC up to $250,000 per person per deposit. So our money is guaranteed. If a bank should fail, the government steps in and would give us our money. So if you have a joint account, you're insured up to $500,000. Individual account would be insured up to $250,000. So you don't have to worry about having your money in the bank in the U.S. because it is insured. Okay, so that's it for Chapter 1, and this is just to help you focus on some specific points in Chapter 1, in addition to attending class, attending the lectures, and reading the book. Take care.